Good morning, Tax Tip Tuesday, 11 out of 52, deferred income. So, deferred income, money that you have been paid for work you have not yet done. Now, sometimes people will be like, why would that happen? Well, for example, some people pay me up front for some accounts, and other people pay me monthly. And there'll be a cut-off point when I prepare my own accounts as to whether I have done the work or not that I've already been paid for. So if my year end was coming up, 31st of March, and somebody had paid me up front for a set of accounts that I wasn't going to complete until April or May 21, that would be deferred income. It shouldn't be in my accounts on the profit and loss as sales in the year to the 31st of March 21. It should be in my sales for 21-22 because that's when the work's going to be done. So instead of being in sales, that would go to deferred income and wouldn't hit my profit and loss. At the end of the day, if I didn't do that work, if that client chose to go to a different accountant, not that they would, why would they do that? But if they did, I would owe them that money back. So by placing it in deferred income, it hasn't yet hit my profit and loss. And why is that a tax tip? Well, say if I was hitting higher rate tax this year, but not next year, I certainly wouldn't want to be pushing any more income into my sales figure for the current year. So have a think about those cut-off points. Last week I talked about work in progress. This week I'm talking about deferred income. They're both things that you need to think about when you're doing your year-end accounts. Obviously, if you have an accountant, they'll be thinking about this on your behalf, but make sure that you provide them with enough information so that they can work all this out for you. Make sure that your accounts are accurate, and on the back end of that, make sure you're paying the right amount of tax in the correct tax year. Have a nice day, everyone.